Welcome. We'll get started shortly. Before we begin, here's how to earn continuing professional education credit for attending this session. There are no polling questions or attendance checks. Instead, you will demonstrate your knowledge by taking a brief multiple-choice quiz using the Earmark app. Visit earmark.app in your web browser. You can also download the mobile app by scanning the QR code on the screen. Log in, or if you're new, create your free account. Be sure to use a valid email address because that's where we'll send your course completion certificates. From the home screen, scroll down to find the course. You can also tap the magnifying glass icon to search for the course. Tap on the course artwork, then the Enroll button. On the Course tab, you'll find the recording and quiz questions. Complete the quiz to earn your CPE certificate. It takes us a few days to create the course on the app, so if you are attending this session live, please wait a few days. We'll email you a link to the course when it is ready. If you have questions or need help, email us at support@earmarkcpe.com. And now, on to the event.
All right. Awesome. Thank you for that intro. My name is Brandon Hall. I run Hall CPA. We are a national accounting firm, CPA firm, tax firm, and we work in all different states. So our niche is real estate investors. And today I'm going to be talking about the passive activity loss rules. This is something that we spend a lot of time with our clients on in terms of tax planning. So I want to educate everybody on how the passive activity loss rules work. This is section 469 of the Internal Revenue Code. And we'll learn about real estate professional status, and maybe even if we have some time, the short-term rental exception / loophole / whatever you want to call it. All right, let's jump into it. So the history of the passive loss rules, and I guess before I actually jump into this, let me give you a little bit of context. So if you have real estate investors as clients, whether they own office buildings, their own single family rentals, multifamily rentals, mobile home parks, RV parks, land, well, I guess maybe not land, then they are going to be subject to the passive activity loss rules. And the interesting thing is that everybody is subject to the passive activity loss rules, but our clients don't often find out about it until they own rental real estate, because the losses are getting suspended because they're subject to these loss rules. But you could also have clients that are investing passively in funds, in syndicates, and those syndicates and funds could be investing in real estate, but they could also be investing in businesses, right? Like, let's say that there's a fund that goes and raises a bunch of capital and buys accounting firms. Well, the profits coming back to the fund that are being then allocated to the investors of the fund would be passive, depending on the structure of the company. So the point is that you don't necessarily have to own real estate to be subject to the passive activity loss rules. It is all about how are you making investments and are you materially participating in those investments. So let's start with the history of the passive activity loss rules. Back in 1986, Congress added section 469 to the Internal Revenue Code. And the idea was that they wanted to make all income and losses from passive activities or from rentals, essentially, to be passive. So essentially any loss in excess of income from the passive activities would be suspended and carried forward. And the reason that they wanted to add that clause is because before 1986, you would have high income earners buying rental real estate using depreciation to accelerate losses, and they would claim the losses from the rentals against their W-2 income or their business income. So Congress thought, hey, it's not fair that rich people can go and buy rental real estate and not pay taxes. So we're going to add section 469 to the code, which is essentially built around the fact that if you have losses in excess of income from passive activities, then those losses cannot be deducted against your non-passive income unless you qualify for one of the exceptions to the passive activity loss rules. So they thought it's going to prevent the abuse of tax shelters, i.e. buying real estate and just having a ton of depreciation on it. And then in 1993, real estate professional status was added to the Internal Revenue Code. So that's section 469C7. And that was added to the code in 1993 because in 1986, there was no carve out for real estate professionals. So if you were a builder or if you were a like broker or agent or something like that, you are in real estate full time. That's all you did. And you're buying real estate on the side as well, like rentals on the side as well. You were unable to use the rental losses to offset your real estate income, even though real estate was your trader business. That was all you did all day long. So in 1993, they tweaked the code to make it a little bit more fair for people that are in real estate full time. So if they're in real estate full time, the idea was if they're in real estate full time, then they should be able to use rental losses because that's tangential to their business. It would be similar to a physician that owns a surgical practice buying equipment for the surgical practice and not being able to deduct the cost of the equipment. So that was the theory behind it. That's why real estate professional status came into existence in 1993, was to give them that boon. So let's talk about what a passive activity is. Section 469C says that there's two types of passive activities. The first is all rental activities. So any rental activity, regardless to the extent that you participate, it is passive unless you qualify as a real estate professional. That's why you see unless IRC section 469C7. The other type of passive activity is any trade or business in which the taxpayer does not materially participate. So this is an and, right? This is not or, this is and. So all rental activities and any trade or business that you don't materially participate in. Now, the reason that it's important to understand the and component, and I actually have a slide on this in a little bit, but the reason that it's important is because you can be a real estate professional, and by being a real estate professional, you essentially get to cross through that first bullet point there. You don't have to worry about all rentals being passive. You are a real estate professional. But you still have to worry about that second bullet point and any trade or business in which you do not materially participate. So it's important to hit both. You have to be a real estate professional. You must also materially participate in your rental activities to make them non-passive. So the passive activity loss rules essentially created two buckets of income. This is the way I like to explain it. You can also think about it as two islands, whatever visual works for you, right? I say buckets. So you've got two buckets of income. You have passive, and then you have non-passive. And the passive activity loss rules say if you're not materially participating and if you have a rental activity, then it goes by default into the passive bucket. And all your other income, like your W-2 income, your business income, that's all in the non-passive bucket. The other things that are also in the non-passive bucket are certain types of investment income, like interest income, dividend income, income from capital gain on stock sales. That is all considered not from a passive activity. I think that is, I was just about to say the wrong site, so I'm not going to say the site, but it's not from a passive activity. And that is considered non-passive. So that goes into the non-passive bucket. So in our passive bucket, we really only have rentals and any trade or business that we do not materially participate in. Now, the problem is that if it's passive, it just gets trapped in this passive bucket. If there's losses in excess of income, it gets trapped in the passive bucket. If there's passive income in excess of passive losses, then the net passive income then goes onto your tax return, right? But your passive losses that are in excess of your passive income, they get suspended on Form 8582. So they don't get to be utilized in the current year unless you qualify as a real estate pro and or materially participate in the activity. Okay. To deduct passive losses, you have to have passive income, or you have to have gain on sale from a passive activity. So this is actually a key learning point for everybody listening to this. We see often, way more often than I would expect, but we see often accountants saying, well, your rental losses are passive, but you also have this income, this passive income from this business. Let's say you invest in a hair salon and you're just the capital partner, right? They're passing profits back to you. You're not materially participating. That's passive income to you. So you're not materially participating, passive income. We see accountants like trying to hard key and do manual entries on Form 8582 because they'll have passive losses from the rentals that naturally offset the passive income from this hair salon business. And we see accountants make the mistake of assuming that rental losses are somehow not allowed to offset the income coming in from the passive business activity, which is not true, right? Because rental losses are ordinary losses. That's their character. They're ordinary. Now, when you apply Section 469, it's like a separate layer of application. So you can still have ordinary losses from your rental activity that can offset ordinary income from another business. It's just that it's passive, right? So if you have passive losses that are ordinary, they can still offset passive income that is also ordinary from another business. Now, the other thing that I want to point out too, another mistake that we see a lot is accountants think that when a passive activity, i.e. a business stake, or a rental activity that is passive, when either one of those sells for a gain, we see the kind of shenanigans of trying to not let the gain flow to form 8582, which is wrong. Because if you look at section 469 G1A, and then there's a treasury reg actually on it as well. The gain from the sale of a passive activity is includable in passive activity gross income. Okay. So even though it's a gain, for section 469 purposes, if it's gain from a passive activity, it's also considered passive income. So your current year rental losses can offset the gain on sale of a passive activity. Really important to understand. Section 469 gets really complex and confusing with that, but those are mistakes that we see around. I've got passive losses and I've got this passive business, and those two should offset each other. So don't get confused with that. And I apologize. I've actually I'm recovering from a cold. I also have pink eye. Having kids is a lot of fun. I love my kids to death, but I always seem to catch whatever they bring home. So if I go hoarse during this, I apologize. All right. So I kind of explain the passive activity loss rules, the purpose of the passive activity loss rules. Now I want to explain, how do you get around the passive activity loss rules? Because ideally, we do want to help our clients get around the passive activity loss rules. And the reason for that is simply the time value of money, right? A dollar today is worth more than a dollar tomorrow. And to prove the point, if you go and you take a dollar to the grocery store today, you might be able to buy a quart of milk, right? Next year, you take the same dollar to the store and you probably can no longer afford the quart of milk, or pick whatever product you want. But the idea is that the cost of goods increases year over year. So the physical dollar that you have, the value of it decreases year over year. So what we want to do is, if we have clients that have large losses, and I say large losses, this could be applied to any amount of losses. You can run net present value calculations on this all day long if you want a more objective way to analyze this for your clients. But the idea, the kind of high level idea is, if my client has a rental activity and that rental activity is spitting off losses thanks to depreciation, I want to claim the losses if I can claim the losses, because it's going to put money back into the client's pocket today, and the client can reinvest that capital today. Are there exceptions to that high level idea? Of course. If my client's in a low tax bracket today and they're going to be in a high tax bracket later, that's a key consideration. But I would be careful playing those assumption games, because even if I get cash back today, I can reinvest it today. Now, if our client's going to go and take their cash back and buy a Ferrari, that's a problem, right? We try to educate them on that. If you're going to get cash back, we want to reinvest it. We do have depreciation recapture at some later point if we don't play the 1031 until we die type of game. So be aware of that. But in general, we want to try to get around the passive activity loss rules if we can. So there's three primary ways to do this. And then I didn't throw a fourth one on there because I didn't know if we'd have time to talk about it today. But the three primary ways to do this: first, sell a passive activity. So what I was just explaining earlier, if you sell a passive activity at a gain, the gain is considered passive activity gross income, and the passive activity gross income can be used to offset or used to net out against any passive losses that you have. So that's great, right? I personally have a rental portfolio. I have suspended passive losses that have accrued. And what that enables me to do is sell one of my rentals without having to go through a 1031 exchange. So I could sell one of my rentals next year. I've actually been considering this. And if the gain is not in excess of the suspended passive losses, then I don't have to worry about jumping through the hoops of a 1031 exchange. Makes the process a little bit easier. So that's what I mean. You can use the losses if you sell another passive activity at a gain. Number two is, if you earn less than $150,000, excuse me, if you earn less than $150,000, you actively participate, you own 10% of the activity, you can qualify for the passive activity loss allowance. The loss allowance is capped at $25,000. And it's only $25,000 if you earn 100K or less. And I believe this is modified adjusted gross income for any of those folks wondering. So if you've got $100,000 of MAGI or less, you get the full $25,000 loss allowance. But as your MAGI increases above $100,000, the loss allowance is phased out. So the loss allowance is phased out $1 for every $2 in additional earnings. So if you're earning $140,000, your loss allowance is $5K, right? So the point of me explaining that piece is we often get clients that are in like the $155,000 earnings threshold. They know about this or have learned about this, and they go, "Hey, I want to drop my income to $149,000. That way, I can get the $25,000 loss allowance." And it doesn't work like that. If they drop their income to $149,000, they've got $1,000 left on this phase out, and 2 divided by 1 or whatever, 1 divided by 2 is $500. So if they've got $149,000 MAGI, their loss allowance is $500. Not really going to be helpful. So to really maximize this, to maximize this, you need to be below 100K. But to kind of benefit from it, you kind of need to be in the mid 120s or so. Once you start getting above 130, it starts to really kind of lose its luster. But this is really nice for anybody that has a full-time job and can't materially participate, right? So that's kind of who it's geared towards, I think, is people that have jobs, they run businesses full-time, they're not earning above 150K, and they are actively participating in their activity. Active participation in this case is just making management decisions. You can have a property manager that manages it top to bottom. You don't have to materially participate. You just have to be part of the decision-making process. So most landlords qualify for this. The one exception would be potentially triple net lease properties. So if you're like buying office space or retail space and you just sign a tenant up and that's it, and you don't talk to them again for 4 years, 5 years when the new option kicks in, that would be a potential where you might not be able to qualify for active participation. But most people that own rentals should qualify for active participation as long as they own at least 10% of the activity. So this is a really nice benefit for folks, and they don't have to jump through any additional hoops. And our clients in this range love that. And we love that too, because it's really easy to report and we're not subject to any additional audit risk or anything like that. The third way to get around the passive activity loss rules is to qualify as a real estate professional, which we'll be talking about here in a second. And then the fourth way, the bonus way, is the short-term rental loophole exception, whatever you want to call it. We've written a ton about that. We've got tons of podcasts on it, presentations on it. It is a very legit thing. The IRS came out with it with their own CCA. I think it was at the end of 2021, December 2021, and basically confirmed the entire thing. So it's great. It's legit. We've been winning IRS audits on it, but it is nuanced and confusing. So at the first blush. All right, let's keep going. So if your losses are passive, if your excess losses are passive, what happens? They become suspended and they get carried forward. Suspended passive losses can only offset future passive income or gain on sale from a passive activity. You cannot qualify as a real estate professional and unlock prior suspended passive losses. So just want to make that point clear. So suspended passive losses can be used as a bank to offset future passive income or future gain on sale from a passive activity. And kind of like the example I was just explaining, it's going to help me whenever I sell one of my rentals avoid doing a 1031 exchange. Now, could I do a 1031 exchange and just continue carrying forward my suspended losses? Sure, I could do that. But there's also all those hoops you got to jump through with the 1031 exchange. That was the reg section I was looking for. So what reg section 1.469-2, passive losses from one activity can offset passive income from another activity. It does not matter if it's rental to hair salon, if it's LP investments in a syndicate to a rental. It doesn't matter. The question is it passive? If yes, they can net out against each other. And that's the reg section for you. All right. Real estate professional status. Actually, we have a question. Does the $25,000 loss allowance, is it only for rental losses, or can it be used for other passive activities? It's a passive activity loss allowance, not just rentals. Great question. All right. rental. Geez, see, I'm like sick. I'm struggling through this presentation right now. I apologize. Real estate professional status, not rental real estate professional status, real estate professional status. So if you qualify as a real estate professional, it allows you to overcome the presumption that your rentals are passive. So your rentals are passive by default. And if you qualify as a real estate pro, then you get the opportunity to also prove that you materially participated in your rentals. That's how we have to think about it. Because if you qualify as a real estate pro, but you don't materially participate in your rentals, then your rentals are still passive. Now, when would this happen? So qualifying as a real estate pro, there's two tests. Spend more than 750 hours in real property trades or businesses that you materially participate, and spend 750 hours or more, I should say, and then spend more time in real estate in those real property trades or businesses than you do anywhere else. So when would you qualify as a real estate pro but not materially participate in your rentals? To answer that question, you have to understand what a real property trade or business is, because there's 11 real property trades or businesses, and rentals is one of the 11. So you could be a broker, for example. In real estate, agents qualify as brokers. So I could be a real estate agent, and I could do that for 2,000 hours a year. And if I'm a real estate agent for 2,000 hours a year, then I have met the 750-hour test. I've also met the spend more time in real estate than anywhere else test, because this is my job. It's the only thing that I do. I'm a real estate professional, right? But if I have rentals that I have not touched, then I have not materially participated in my rentals. They are still passive. So I have to materially participate in my rentals in order to make them non-passive. Now, most of our clients are landlords, so they don't really have to worry. If they're going to qualify as a real estate pro, they're going to qualify on their rentals. I would say that's true for 80% of our clients that qualify as real estate pro. But for the other 20%, they have to think about it, right? It's I'm a developer, I'm a wholesaler, I'm a property manager, and I'm doing that full time. I'm a real estate professional, and I also have to go and materially participate in my rental activity. So just remember, when you're advising clients on this, that real estate professional status is one piece of it. Material participation is the other piece of it. Now, you can have hours count towards both if you're being a landlord, and that's how you're qualifying as a real estate pro. But let's talk about that. So personal service hours. If you have to spend, excuse me, if you have to spend 750 hours and more time in real estate than anywhere else, when you're explaining this to a client, inevitably the next like 3 questions is going to be, well, what time counts and what time doesn't count? So we have developed a litmus test, and then I've got a list of things that count and don't count here in a second, based on reading a bunch of tax court cases on real estate professional status and Section 469. The litmus test is, if the day-to-day operations of your rentals are unaffected by the hours that you are logging, then the hours do not count. So if you are going to a real estate meetup, how is that helping your rental collect rents or pay the bills? It's not, right? It's not going to help you with that. Your rentals would still collect rents. They would still pay bills, whether or not you went to a real estate meetup, whether or not you went on I'm not going to name the educational company, but the educational company that has the real estate cruise. Okay. Going on the real estate cruise might be a lot of fun, but it's not going to be real estate professional status hours. It doesn't help your rentals collect rents or pay bills. Doing a bunch of research is not going to help, right? I can sit on Zillow all day long, and that doesn't mean that my rentals are better. They're not going to collect more rent. They're not going to pay more bills, right? So we really have to hit this litmus test home with our clients, because our clients, especially in the real estate space, there's a lot of educator gurus out there that will make false statements. I don't think that they intend to, but they make false statements. They get everybody excited, and everybody thinks, especially higher income earners, they think that this is super easy, and it's not super easy, and it's also highly litigated. So we as tax advisors owe it to our clients to tell them what they need to hear to win IRS audits, and that requires us telling them, hey, if you are just kind of logging what I call junk hours, you're not going to qualify as a real estate pro. It's going to get tossed out by the IRS in the event of an audit. And these audits are drastically ticking up right now. So what time doesn't count? Let's start there. Investor hours do not count. There's 3 buckets: investor hours, education and research, and then travel time. So investor hours do not count unless the client is involved in the day-to-day activity of managing the rental. Okay. And what I translate that to is they don't have a property manager and they self-manage the activity. If they are the ones that are self-managing the activity, then they are involved in the day-to-day activity, assuming that there is work to do and it's not like a triple net lease property where it's just super, super passive. Um, so if the property manager is working on the property, then the property manager is the real estate professional, not the client. Right now, the client's popped out to this investor level. So investor hours are studying, reviewing, monitoring financial statements, preparing summaries of financial or operations. We also include bookkeeping in here, because when you really like read and understand what investor hours are supposed to mean, it means anything that any investor would do to make sure that their rental is performing well or their investment is performing well. And when that pertains to rentals, any investor is going to do the bookkeeping, whether or not they're involved in the day-to-day operations of the activity. So we include bookkeeping in for our advisory services when we're doing this with clients. We include bookkeeping in there. You can't just hand the property over to a property manager, do the bookkeeping, and say that you are a real estate pro. That's not how it works. Real estate professional status is supposed to be there on the ground, swinging the hammer, evicting tenants, talking to tenants, negotiating leases. That's what being a real estate pro is, not just sitting back, collecting checks and doing the bookkeeping. There's a tax court case where this was actually, I would say, codified, and that's W.A. Barniskis 78 TC Memo 226. So check that one out whenever you get a chance. The second bucket of time is education. Actually, before I jump onto the second, if you are managing the day-to-day, like if you're involved in the day-to-day, you don't have a property manager, then all of that time can count. Okay. And I say can, it might not necessarily count, but it can count. So if your clients are self-managing, they've got a much better shot at this, because they'll be able to claim all of this extra type of time. We often also get questions about if I am closing on a property, coordinating with the title attorney and the closing attorney and the insurance broker and the mortgage brokers, all that time count. And this is what we again say, that's investor time, right? Any investor is going to do all of that type of stuff. That's investor level hours. You don't have the property yet, so there's nothing to manage. There's no day-to-day operations to manage. So that's kind of our stance there. Education and research time is the second bucket of time that does not count for real estate professional status. There's 2 tax court cases here. But if you think about it, education and research time is, again, not impacting the day-to-day operations of the rentals, right? The rentals are still going to collect rents. They're still going to pay bills, whether or not you have this education and research time that you've performed. And there's 2 tax court cases there that you can read through as well. And I'm going to skip over that just in the interest of time. Travel time is a third bucket, and this is a question mark. So the IRS Audit Technique Guide on Passive Activity Loss Rules says travel time does not count. There are many tax court cases that say travel time does not count. However, there is a tax court case, Lay versus Commissioner, where the tax court ruled that travel time does count for real estate professional status. So the facts around that case, though, were that the rentals were local and that they were being self-managed, and the taxpayer had to drive out to them multiple times, I believe a week. So it was a heavy requirement. It was a big requirement to keep the properties going and keep them managed and operating on a day-to-day basis. So therefore, the travel time counts. If your rental is an hour away or 2 hours away and you visit it periodically throughout the year, your travel time is not going to count. There's another tax court case, Lucero versus Commissioner, that came out, I believe it was 2020, maybe it's 2021. But Lucero has a couple short-term rentals, visited them 6 to 8 times a year, and logged the travel time as material participation time, and that was tossed because it just wasn't significant enough. That he didn't need to travel to the rentals in order to keep them operating on a daily basis. And that is, conversely, Lay versus Commissioner, the taxpayer did need to travel locally to keep the local rentals operating on a day-to-day basis. I love showing this slide to my clients and also to prospective clients. And any time that I'm doing a presentation on the passive activity loss rules to real estate investors, I love showing this because in real estate, everybody gets this like this FOMO going. Like everybody, you get in these little real estate groups, Facebook groups, online groups, and one person goes, I'm going to be a real estate professional this year, and then you just see this like swarm of people that are all like, I'm me too, man, I'm going to be a real estate professional, this could be awesome. It doesn't work like that, right? Like you can't just log time just for the sake of logging time, just so that you can hit the 750 hour test. And there's actually a regulation that reinforces that. So I love showing this slide to people, and I'll read this in case you're on audio. It's, if the principal purpose for the performance of services and logging hours is to avoid limitations under Section 469, then the hours do not count. So this is often where we'll see like tax court cases related to, it took me 24 hours to replace a toilet, or 48 hours to replace a toilet, 24 hours to replace blinds. Just these insane time allocations to tasks that do not take that long. It took me 3 hours to shop for coffee filters in Bed Bath & Beyond. These are I'm getting, I think, the numbers wrong, but these are real examples from tax court cases on real estate professional status in Section 469. So that's the thing to remember, is that if we're logging time here just to inflate our total hours, because we do have to keep a time log. We have to keep a time log as we go that documents when we worked on the property, what property we worked on, what we did, and how much time we spent. So if I'm doing that and I'm inflating my time, I am setting myself up for failure. So let's talk about what time does count for real estate professional status. Hours spent acquiring the property, showing the property to prospective tenants, placing rental ads, taking tenant applications, screening tenants, negotiating leases, cleaning units, maintaining the grounds in the units, doing repairs, doing improvements, supervising a property manager. I'm going to put an asterisk on that and come back to that. Purchasing supplies and materials, inspecting the property, communicating with tenants, collecting rents, evicting tenants, traveling to your rentals. All of those things count for real estate professional status. But one second. Okay, cool. But when you look at this list, what does that sound like? To me, that sounds like a property manager. Okay. So again, like if I am not managing the property, if I'm not the one doing the work, I'm not going to be a real estate professional. And if you are an advisor and you're taking clients' word at that and they're pressuring you, I know how this works. So I've done this for a long time. Your clients will come in, they'll strong arm you, they'll pressure you. They'll be like, oh, deduct it or I'm out of here. Let them walk. I promise you, you will be better off for it. It is not worth your license. It's not worth the risk to take this position that, yeah, somebody that's got a bunch of junk hours is going to qualify as real estate pro. And frankly, we need a lot more advisors out there to help the entire landlord industry gain alignment as to what actually counts and doesn't count, because there are a lot of accountants that do not care. They will just say, yeah, we'll count you as a real estate pro. Who cares? Audit rates are low. We don't have to worry about it. And that is a terrible mistake, as we are now seeing through all these IRS audits that are coming our way, because their accountants can't help the client anymore defend them during an IRS audit. Now, I said I was going to come back to supervising a property manager, and I put an asterisk on it. This is a pretty big gray area right now. We don't really have tax court cases on this. So the way that we kind of explain this to clients, because what happens is clients will come in and they'll say, well, I've got 2 property managers that manage my 5 properties, and I check in with them once a week. So that time can count, right? I'm supervising, I'm involved. And I would generally say, no, that time doesn't count. That's just being an investor. Any investor would check up on their assets on a regular basis to make sure they're performing well and help guide decision-making process. However, if your client is at such an operating scale where it is a significant portion of their day just to manage the entire portfolio, that's where we kind of start tossing up like the supervising a property manager probably counts at that point, because it's kind of almost like it's part of their big team. But I mean, we're talking about significant sizes here. So this is not going to be like the mom and pop that's got 5 rentals. This is going to be somebody that's got 50 rentals, and they work on this for 20 to 30 hours a week type of deal. That's when supervising a property manager, I think, becomes or starts to count for that time. But I could be wrong on that. So take that with a grain of salt. All right. Real property. Let's talk about real property trades or businesses. So we're still talking about real estate professional status, and remember, 750 hours and more time in real estate. But we talked about personal service hours, and now we're going to talk about real property trades or businesses, because it is 750 hours in real property trades or businesses. So there's 11 real property trades or businesses. Development, redevelopment, construction, reconstruction, acquisition, conversion, rental operations, management, leasing, brokerage. Now, if you go and check out Treasury Reg 1469-9, you will see definitions for almost all of these real property trades or businesses. They've been adding definitions to that regulation over the years. It's actually been really great to understand, to get a clearer picture as to what these words actually mean. So that's cool. Now, there are also call outs, though, as to what is not a real property business. Surprisingly, HVAC contractors are not running real property businesses because they install HVAC units, which is not real property. What I'm sure we'll see that argued at some later point. But it's very interesting to go and read the actual definitions of what these things actually mean. Now, if you are involved in multiple real property trades or businesses, you can group the multiple real property trades or businesses together for the purpose of testing the 750-hour requirement and the more time in real estate than anywhere else requirement. So I do just want to make that clear. So you could be a landlord, you could also be a broker, and also a property manager for third-party management or third-party clients. And you could group all three of those together for the purposes of testing 750 and more time in real estate than anywhere else. Now, this is not one of the more formal grouping elections, which we'll talk about here in a second. This just kind of happens automatically. Now, CCA 2015-04 and 04010 said that it basically came out and said that a broker is a real property broker. So it's a real estate agent or a broker. So real estate agents are considered brokers under the brokerage definition of real property trades or businesses. But a mortgage broker is not a real property broker. A mortgage broker helps put together buyers and sellers of notes, which is not real property. So again, this is where the nuance starts to come in, and it's really important for you to understand the nuance to appropriately advise clients. I'm not going to go into the Calvin Eco case, but there it is for you. All right, material participation. So we talked about personal hours. We talked about real property trade or business. Now it's time to talk about material participation, because these are all things that are in that 750 hour and more time in real estate definitions, right? 750 hours of service in real property trades or businesses that you materially participate in. So we have to talk about material participation, because without it's embedded in the in the real estate professional status tests, but also without material participation, real estate professional status means nothing. So there's 7 tests for material participation. The first 3 are the ones that we see most often with our clients. Participate 500 hours in the activity, 500 hours or more in the activity. Your participation is substantially all, meaning basically nobody else does anything. Okay, so if I have a rental and I'm the only one that does everything related to it, including all the rehab, the repairs, everything, talking to my tenants, structuring the leases, negotiating, evicting, then in theory, even if I've only logged 50 hours, if nobody else touches it, nobody else is involved, then in theory, my 50 hours is substantially all of the participation. It is actually all of the participation, right? So in theory, I will have met test 2. Now I say in theory because we don't see many tax court cases related to this or that argues the substantially all test. So it's kind of hard to lock into that. And I think it's a little risky for tax accountants to be giving that type of advice. So we try to shy away from that personally. But then the third test is participate 100 hours and more than anyone else. And so that is like we see this a lot on our short-term rental clients. They participate 100 hours and then they try to outwork the cleaners, the repair people, etc. So they'll log the time that the cleaner spends at the property. And if the cleaner spends 105 hours, then the client knows they have to spend 106 hours. They have to spend 100 hours and more than anyone else. Interestingly, if you have partners in a short-term rental operation or any sort of operation, this 100 hours and more than anyone else can get a little sticky, right? Because you have to now outcompete your partners. So that's just something to be aware of there. Now, you do have to track everyone else's time. That's the caveat with test number 3. So if you're going to go for 100 hours and more than anyone else to prove that you've materially participated, you do have to show that you actually outworked everybody else, meaning that you have to have a time log not only for yourself, but for everyone else. That is hard to do. So the safest thing to do is hit that 500-hour test for your material participation. But again, we can't be logging junk hours. This has to be actual real work, right? So, and we'll talk about grouping elections here in 1 second. That'll make this a little bit easier. Let me just water real quick. All right. When we're talking about material participation, spouses can combine their time, but that's not the case for the 2 real estate professional status tests. So, one spouse, if you have a married filing joint client, one spouse has to qualify as a real estate pro completely on their own. So they got to meet the 750-hour test and more time in real estate test completely on their own. But in terms of material participation, spouses can combine time for the 7 tests that I just showed you. Now, where this shows up in practice is going to be when you have a real estate agent spouse that loves being a real estate agent but hates the rentals. The other spouse doesn't mind managing the rentals. So the real estate agent spouse, that's all they do. They hit the 750-hour test. They hit the more time in real estate test. They have qualified as a real estate professional completely on their own time, but they don't touch the rentals. The other spouse manages the rentals. They still have material participation, because when you're looking at material participation, you combine the spouse time. That's not the case for real estate professional status, but that is the case for material participation. So married filing joint is considered one individual for material participation purposes. A really cool little hack if you've got spouses that don't really want to touch the rentals. All right, more notes on material participation. If you have clients that are invested in limited partnerships, and limited partnerships does not have to physically be an LP, right? It could be the definition of a limited partnership, which is basically just super passive. And I say basically super passive. There is a technical definition. Please go look at the regs. But the key is that you could be invested in an LLC and still be considered a limited partner. So that's what I'm trying to say. If you are materially participating in a limited partnership and you're making a grouping election, you just have to be really careful, because it limits the tests that you can use at your disposal to actually prove material participation. So that's just something to be aware of. All right, there's 3 main grouping elections. The first grouping election is Treasury Regs. It's Regs 1469-9G. And this is a grouping election that enables you to group all rental real estate, rental activities, to be clear. It enables you to group all rental activities together for the purposes of material participation. It is only available to those that are qualifying as a real estate pro, and frankly, that's the only time you would need it anyway. Let me explain. The second test is Reg Section 1469-4, second test. The second grouping election is Reg Section 1469-4, and that enables you to group essentially like-kind economic activities. So we see this with short-term rentals, for example. You also see this if you are operating a business out of an office that you own. You can group the office with the business activity and get around the passive activity loss rules thanks to that grouping election. And that's a little nuanced as well. And then the last one is Section 469C7. It just enables you to group multiple real property trades or businesses together for the purposes of testing real estate professional status. Now, I said in the first bullet point, Reg Section 1469-9G, I said rental activities. I didn't say rental real estate. I started with rental real estate, but then I corrected myself and said rental activities. And it's really important to be very clear with the definitions, because a short-term rental is not a rental activity under Section 469. So you cannot use the 469-9G grouping election for short-term rentals. So short-term rentals cannot be grouped with long-term rentals, assuming that they meet one of the exceptions to the definition of a rental activity, which we're not going to cover today because we don't have time. But I just want to call that out, because we do see that when we're helping clients with IRS audits. We have seen prior accountants making the 469-9G election and assuming that all the short-term rentals get grouped in, and the auditors are blowing it up. So you have to be really careful with the grouping elections and understanding how they work. Now I want to talk about how suspended suspended passive losses are unlocked, and then the next couple slides we'll also talk about like if you have suspended losses and you've done the grouping election, what that means for you. So there's two ways to unlock suspended losses. The first is to generate current year passive income, and that could be passive income from current year passive income from operations. Any business that you're invested in passively, any rental that you're invested in passively, if it's generating passive income after depreciation, then that passive income can flow into the suspended losses that you've banked. The second way to tap into suspended passive losses is to sell a passive activity, because the passive activity gain becomes passive activity gross income, and the suspended losses from passive activities can offset passive activity gross income. But I've said this early in the presentation, and I will say it again: you cannot unlock suspended losses simply by qualifying as a real estate professional. So if we've got $100,000 of suspended passive losses sitting on the books, and then next year we qualify as a real estate pro, we cannot unlock the 100K of suspended passive losses. They are related to a former passive activity, and they remain suspended year over year. You can carry suspended passive losses forward indefinitely, so you don't lose them. You can use them at some point, but you don't get to unlock them just by qualifying as real estate pro. Now, when you sell a passive activity that has suspended passive losses associated with it, it's going to be deducted in the following order. First, against any gain, including depreciation recapture from the sale. And then if there's still a loss related to the activity, the loss is deducted as a non-passive loss. All right. So if you have a suspended loss associated with a rental, that loss comes out. If that loss is in excess of the gain, then the excess comes out as a non-passive loss and offsets your income on your 1040. Suspended losses are tracked per property, and they are deducted in full when that property is sold, unless you make the grouping election, right? So if you make that 9G election, that 469-9G election, it can hurt you. However, I will say I think it only really hurts you in down markets. Now, what that means is imagine like 2008, 2009 replaying itself. So we have legitimate losses. We bought a property for 200. Now it's worth 100. Not only do I have suspended losses from operations, but I also have an actual legitimate loss. When I sell this thing, I have a ton of losses. If that happens, this is when the 9 election hurts you. The 9 election does not hurt you. And this is the caveat, because a lot of people mess this up. The 9 election, the grouping election, does not hurt you if you have gains in excess of losses, because you can always use suspended losses to offset passive activity gross income. And remember, when I sell a passive activity at a gain, the gain becomes passive activity gross income. So if I've grouped 50 properties together and I sell one property, that is not the disposition of the entire group, but it also doesn't matter as long as the suspended losses, are not in excess of the gain associated with that specific property, if that makes any sense. So the suspended losses from the group, the 50 property group, can be used to fully offset the gain on sale of the one property that I sold, but they cannot, I can't go further than the gain on sale. That's where it kind of caps. Okay. And that is true even if that one property still has losses associated with it. I cannot go further than the gain on sale. So the suspended losses can be used to offset passive activity gross income, which is the gain on sale, but the suspended losses cannot be used further past the gain on sale. So I can knock out the gain on sale, but I can't go beyond that. That's where the 9 election can hurt you. I hope that makes sense. Now, suspended losses are not all bad news. I kind of gave my example of I've got suspended losses personally, but it enables me to have some flexibility whenever I'm selling. So it just gives you a little bit of flexibility. But the other thing that it can do as well is help you make future investment decisions, right? Like, let's say I've got $300,000 of suspended passive losses, and I don't want to sell any of my rentals, and maybe I want to do 1031 exchanges, and I just want to keep that bank of 300K. Well, maybe I go and find a business to invest in passively. I mentioned a hair salon earlier. It's like one of my favorite examples. I hope one day my local hair salon will call me up and say, we're looking for a capital partner, but we don't want you to help us operate the hair salon. And we'll give you a profit share as a result of that. And that profit share, the income coming back to me would be passive as a result. I'm not going to materially participate in the hair salon when I make that investment. So that's passive income coming in that can flow to those suspended passive losses. So here's some examples. We've got surgery centers. That's big with physicians. Surgery centers are generally considered passive. I believe there was a tax court case, Hardy versus Commissioner, back in 2012, where this specific thing was talked about. You can invest in something called a PIG, which is a passive income generator. And essentially, that's just any business that produces cash flow, right? An accounting firm could effectively be a PIG. Now, in the financial world, they tag like certain investments as PIGs. So that's where that term comes from. And then there's a few other things. But the important thing is that those deals are everywhere, and you can help advise your clients on like making connections in the local community, the entrepreneurship community, and seeing who needs a little bit of capital in an already profitable business if they need it for expansion or for whatever purposes. All right, let's talk about how the IRS audits real estate professional status. First, and I want to talk about this because I started my firm in 2015/16. And going all the way through December 2023, we had maybe 3 total audits that we helped with. 1 was our client and 2 were inbound. Since December 2023, we've had 4 to 8 a month. The IRS, and some of those are our clients. Most of those are inbound requests for help. They're saying I'm getting audited because I took tax losses against my income, and my accountant says they can't help me. They don't want to help. They can't help, whatever. We're helping a lot of these people now. So we've got, I think, like 20 active right now. And it's been very interesting working with the clients and the IRS on this. My theory is that with the IRS's additional funding, they hired a bunch of auditors, and now they're giving them a ton of work. Because the auditors that we've been working with, we've found that we've had to spend a lot of time educating them on how Section 469 works. And it's been a good experience all around. The auditors have been great to work with. They're very, very nice people. But I want to kind of go over now how the IRS steps through Section 469 audit. So first, they're going to be asking you, they're going to do a lot of like background questioning. They're going to ask you about your life. What's going on personally? What's going on in the business? What's your job? Do you have any civic activities, any hobbies, any family? And what they're trying to do, especially as it pertains to taking losses from my rental activity, they're trying to figure out whatever time log you're about to give them that shows that you qualify as a real estate pro and or you hit the material participation tests. They're trying to triangulate, do you even have enough time realistically to do what you say you did on your time log, right? So if they find out that you're like super involved in your community and that's what you do every day, all day, and you have 5 kids and you're busting them around every day, all day, and then you tell them that you spent 750 hours working on your rentals, they're going to call BS, right? They're going to say, no, I don't think so. And they're going to really challenge you. So they're trying to triangulate here, how much time do you actually have to spend on the rental real estate? They're going to examine your documents and records. They're going to review property management contracts and duties. So sometimes we see clients say, well, yeah, I've got a property management contract, but I do all the work. And that's not good enough. You have to sign a new contract with your property manager that divides the actual work. So the scope of work needs to be very clearly spelled out in any agreement. Otherwise, the agents will just say, well, you said that you do all the work, but now you have a property manager contract that says they do all the work. We're going to go with what's hard coded and signed. So make sure that your documents and records support the story that you're painting if you are helping a client with an audit. They're going to request a time log, and they're going to review it for education, research, investor hours. They're going to then toss those out pretty much every time. So what we do now, and we've been doing this since 2018, we don't take the position on a client's tax return unless they furnish to us a time log, and we're going to scrutinize that time log much like an auditor would scrutinize a time log. And so we're going to be challenging the education, research, investor level time, the travel time, and we want the client to do the work at that point to strengthen the time log versus 3 years from now when they get audited and they can't remember anything. But that is the number one issue with the clients that we are helping, the new clients that are inbound that we're helping. They don't have strong time logs. They've got 200 hours of education and research time booked. And when you tell them you can't do that, you got to go kill all that time, and you got to really analyze, do you actually have a lot of them don't actually have enough participation time. So they shoot themselves in the foot by essentially fluffing their time log. But the auditors are smart about the time log. I will say that is the one thing that they know to look for, and they know how to comb through. So that time log has to be bulletproof. It cannot be fluff. And you, as the advisor, I think that you expose yourself to some risk if you are not giving that advice to your clients. And my advice would be to even do it in writing. So make sure that you tell your clients you need a strong time log, or I'm not going to take the position for you. And every once in a while we have a client that gets mad at us, especially if they're already in real estate full time, right? So they'll be like, well, I'm a real estate agent. This is all I do. I'm like, I don't care. You still have to give me a time log. Well, I don't want to do that. Well, then you can't claim the position. I'm not going to claim it for you. You can go find another accountant to do that. We're not taking that risk because I know on the back end, this is the first thing they're going to ask for. They are going to scrutinize your day-to-day involvement in the activity, as well as other commitments you have, such as work, volunteer, kids that take up your time, kind of like I was just saying. And I'm going to wrap up with this. Somebody said, are there any slides? It looks like I'm still screen sharing. Man, if you guys have been looking at my face the entire time, I apologize. Cornelius, yes, there are slides. I think I'm screen sharing them right now.
Maybe he means if he could download them or something. I'm trying to think,
okay.
Brandon. I see your slides. Yeah.
Okay, cool. Okay. Yeah, I could shoot over the slide deck to the Earmark team. I know this is a lot of information and it's kind of dense. So I'll make sure that they have that and they can distribute that. So the last slide here is from the IRS Audit Technique Guide, which actually went down the other month or last month, I think. They took it offline. I haven't checked to see if it's back online, but there used to be a big passive activity loss guide, audit technique guide. Anyway, 2 quotes that I found really interesting that I love sharing with my clients. Quote number 1, rental activities by nature do not require significant day-to-day management. Quote number 2, in many circumstances, an individual rental activity will not require 500 hours of participation. The reason I like to share this with clients, because again, when you start like laying down the law with clients and telling them what they actually need to hear, very few accountants are willing to tell clients what they need to hear related to Section 469, by the way. So when you are the one of the few that's willing to take the leap and tell the client what they need to hear, it's good to have some ammunition. And so this is your ammunition. So what I do is I tell clients, look, I know that this is kind of painful information, but I want you to understand that I have your best interest in mind. If you get pulled for an IRS audit, I want you to win. So I want you to do what you have to do today to win in the future. And I also want you to understand that the IRS, the frame of mind that they have when they are coming in to audit you is that rental activities is easy via these 2 quotes. Here are these 2 quotes that prove that, right? So I love sharing these 2 quotes with clients because it helps them move past this kind of FOMO that they heard about in whatever real estate group they were in, where some accountant is letting somebody that's working at Google or Uber for 40 hours a week qualify as a real estate pro, and they've got FOMO and they want to do that too. I say, look, we can get you there if we do it legitimately, and we'll step you there over time, which might take years, but you have to restructure how you work. You can't just jump. It's not as easy as just checking a box, but that's what the other accountant's doing for their clients, and it will catch up to them at some point, and you will owe back taxes and penalties. So I like to share these 2 quotes because it just helps reinforce the message that I'm trying to share with my clients, which is I want you to win IRS audits. I want you to be able to substantiate this position, and I would not be operating at the highest professional level if I was not telling you what you need to hear to substantiate your tax positions. I'm not going to be the firm that tells you what you want to hear to mitigate taxes. That is all I've got. I answered a couple questions as we went, and I know we're at time, so I will turn it back over to Zach. Thank you very much for sticking this one out.
Thanks, everyone. And if you're here live, here's a quick reminder on how to earn CPE for watching this webinar.
Today's event has ended. To earn CPE, go to earmark.app or scan the QR code on the screen. Then log in or create your free account. Search for the course by tapping on the magnifying glass icon on the home screen and then entering the name of this event. It takes a few days to make the course, so if you're attending this event live, keep an eye out for an email letting you know when the course is available. Pass the quiz to earn your CPE, then tap the button to email yourself a certificate. Stay tuned for more events from Earmark. Thanks for joining us, and we hope to see you again soon.